All right, the Fed balance sheet's in. Let me do a little pre-market, talk about the GDP, the balance sheet, Treasury account, that kind of stuff, and then we'll jump over to the charts. So, big news on the balance sheet, and it might not look like very much over here. It's like a little tiny bump, but this goes, this is like the financial crisis back here, 2008, where the balance sheet popped up and then flattened out for a while. Well, let's go zoom in on the last, I guess, year, and then and we're on the Federal Reserve website. This is Fed Reserve Bank of St. Louis, the FRED data. And so this is the Fed balance sheet. Let me just show you how to look at this thing. So this is the quantitative tightening zone that we were going into, 2 years ago. And then we started increasing the balance sheet a little bit into the crisis, the Feb 20 collapse where the balance sheet went crazy. And check out what the balance sheet has done over the last couple of weeks. So, I mean, they were expanding it like crazy over the last couple of months, but 3 weeks ago, it flattened out, down, and down again. So we just got another down balance sheet. It went down from, 7 trillion 94 to 7 trillion 82. So basically we went flat, down a little bit, flat. So the balance sheet is not accelerating downwards, but it has stopped. The balance sheet stopped. They are not doing QE infinity or QE anything right now. They're not doing any QE for 3 weeks. Nothing. They're not buying anything. They're not buying bonds, mortgage-backed securities, treasuries, nothing. Flat. And they've taken some money out of the repo markets, and that was this down move here. And so this is the big thing I'm watching on the Fed's end. Is the Fed adding new liquidity into the system? Because the Fed can get money into the financial system as bank reserves, but the Fed cannot create spending money. Well, not directly. I mean, through these special programs that they're creating, they sort of can. But this is huge. The Fed balance sheet is down. It's down again. And let me jump over to the Treasury General Account. Yeah, so same thing here. The Fed website. Here's the Treasury General Account. And so I call this the helicopter general account. This is where since 2008 the Treasury account moved from private banks over to the Fed. So now the Treasury keeps their money in a Fed account, and it has been pretty low. And then when it goes up, they have a tendency to spend a chunk of money into the economy. And this time it has just gone up like insane. And so yeah, I've been trying to figure out where all the Fed money is actually going, and a chunk of it has gone here, like $1 trillion, has gone into the Treasury account. And so, they're talking about infrastructure bills, they're talking about some more stimulus checks, things like that. Like they have $1.5 trillion like on hand right now that they could spend in a week. So watching to make sure that they don't pass a bill and just drop like $1 trillion directly into the economy, because that will definitely change some liquidity stuff. But the Treasury account is going up. That's taking liquidity out of the market. The Treasury collects taxes into this account, and they take money from the Fed into this account. And so that's liquidity that is held out of the economy until they decide to spend it. And when they do spend it, it is spending money. So that's why I call it helicopter money. This goes into actual people's bank accounts that can be spent in the domestic US economy. And so this money drives inflation. So what I think they're doing with this is the interest rates and the bond yields have been kind of trading low and a little bit sideways, but they haven't started pushing negative. And I think they're ready with this. And they have all these bills sitting in Congress, infrastructure bills, stimulus bills, all that stuff. And I heard people saying that they might want to spend this around election time or something to buzz the economy, and that's not what I think is happening. I think that they're expecting downward pressure on the interest rates, on the bond yields, and once you press into negative territory on those, that's a deflationary environment, and that's what this inflationary money is for. That's what I think they're going to do, is if the bonds trade to negative yields, they're going to blast some inflationary money to combat that. And I think that's what this helicopter account's all about right here. But just the outlook right now, we've had 3 weeks in a row with the Fed balance sheet going down, so no new liquidity, and the Treasury going up pretty dramatically, which is they're taking liquidity out on both ends right now, out of the markets. And trying to follow the flow of foreign funds has been a little bit difficult. It's been kind of flowing back and forth, so I don't think there's much of a change there. But from the Fed and the Treasury perspective, this is negative liquidity, which is a huge reversal from the massive expansion that we've seen over the last few months. Like now we're actually getting negative liquidity from the government, and so there's that. There's that to look at. Yeah, the foreign money flows look back and forth pretty neutral. It doesn't look like a big trend right now. And then the what was the other thing I was gonna say? Oh, the rotation, like the rotations, because we're coming to the end of the quarter. So there's a big theory that since bonds have not gone up much, and the stock market did a huge rally. This is one of the biggest quarters in history. That 60-40 kind of portfolios that have like 60% stocks, 40% bonds, or whatever. Like now that stocks rallied and bonds didn't, now the portfolios are unbalanced where they're at like 70-30, and so when they rebalance portfolios, they can sell they can sell stocks and buy some bonds. So the next week, there's we want to take a look and see if we start seeing a rotation from different asset classes to other asset classes. And that's not relative to liquidity. Those are just different assets relative to each other as things kind of rebalance. But that could be a downward pressure possibly, but the liquidity thing is definitely a downward pressure. And that has been the key indicator over the last several months is the liquidity. And you don't just look at the Fed balance sheet because that's new money going in, but the Treasury account is pulling money out at the same time. And if you see the Treasury start to go down, that's new money. That's them spending it into the economy. So you have to look at both of them at the same time and try to figure out the liquidity, the government liquidity for both of them. So those are those accounts. And then, we got GDP numbers. So I thought we were going to get an important GDP number. We got a dumb GDP number, which was they just went back and reevaluated Q1, and it's still around 5%. The number didn't really change. Like, good job predicting a past quarter that you can already see. So they already knew what the Q1 GDP is, like -5%, and they already knew that, and they posted about the same. The data hasn't really changed on that. So that's not particularly important. That's from the Commerce Department. But the IMF did a huge world GDP study also at the same time, and those numbers actually came in surprising because they were projecting like -3% or something like that on the world GDP, and they bumped that up to like almost 5%. It was like 4.9 minus 4.9% on the world GDP, and that is the worst world GDP year over year number ever in history. And that's probably not too big of a surprise because this is really the first worldwide massive monetary kind of contraction, recession, depression thing that's ever happened. So, but the countries that looked like they were going to rebound a lot faster aren't, basically, the Asian countries and things like that. And then they did do a year over year estimate on the US GDP, which was -8% year over year, which is a big negative, and that's including the US recovering to the end of the year. So like -5 for the first quarter, and then the next 3 quarters combined is enough to pull it to -8 for the whole year. So it's the GDP numbers from the IMF were worse than expected, but the Commerce Department hasn't come out with Q2 numbers. That's what I thought they were going to have, but we don't have Q2 GDPs. We still have crazy range of estimates on Q2 quarterly GDP. As I've seen -25 and I've seen -52. Like, it's a huge range, and everybody knows Q2 GDP is going to be bad. It's just, I guess how fast do we recover from it is the big deal. And let me go jump over to the charts. All right, here's the S&P. I'm in a 15-minute chart. This is the overnight action right now. So this is just early, really early, not even pre-market stuff yet. And we had a big pop to close here. And so yesterday I was looking at this, and it looks like we have potentially, 1, 2, 3, 1, 2, 3, and then 1, 2, 3, 4, 5. Kind of an expanded flat here as far as an Elliott wave shape. And so for an expanded flat, I was thinking of for the bearish case, see if this thing starts a wave down right here, which would continue through, kind of this size down to this kind of range here. But the more that it flags out sideways or goes flat sideways, the less bearish it's going to look, and it's looking less bearish right now. And so basically what we have in the market is really dead momentum, where we're not really trending anywhere. We're just kind of sitting around, but we have really high volatility. So what we've been getting is just kind of flat zones, and then it'll pop to another flat zone and pop to another flat zone. So it has enough volatility to make really big moves, but it doesn't have enough momentum to really trend anywhere at the moment. So that is kind of from a, kind of swing trading look, trying to figure out a momentum move here. So, I mean, the fundamentals are obviously bearish, and they have been bearish for a long time, for a year or something. And the liquidity now has switched from positive liquidity to negative over the last couple of weeks. And it looks like it's continuing a negative liquidity pattern, which should be downward pressure on the markets. And then the actual, momentum and trending right now, it's high volatility, big moves possible, and tiny momentum, no real direction indicated. And not only is there no direction indicated, but we are just in the middle of absolute nowhere right here with no direction indicated. So this is a weird spot to be here, because even the zone that we have been trending in, we're in the middle of that zone, but we're also dead in the middle of two major support trend lines. This is the bull market line that held up the last 2 years. I call it the Volmageddon line. And this is the 12-year support line off the bottom of the financial crisis that held that whole 10 or 12-year bull run, however you want to count the bull run. And we're in between these zones. We're above the 120 moving average. So yeah, on the technicals, when you get above this moving average, that's kind of the bull market side of the chart. And so if you're in a bear market, you can cross it, but you usually get rejected out of here pretty fast. And so in a bear market model, you would not expect to stay above this thing very long. And in a bull market, technically it wouldn't be considered a bull market until this line starts trending up and you test off the top of it. Once it's trending up and you bounce off of it, then that starts to look like a bull market. And then same thing with a bear market. If it's trending down and you bounce off of it this way, then it starts to look like a bear market. But we haven't really done either of those. Like, we had a massive crash that pulled it down, and now we've crossed straight over it. So it's not from the moving average kind of technicals. There's no indication of what kind of market this is. And from the kind of bubble model and the long-term support lines, we're underneath this one. So this is a bear market case, rejecting downward off of this line. There's still a bear market model, but we really need to break and backtest this line to get into a long-term bear market kind of model right now. This is just kind of swinging. It's really in the middle of nowhere, which is pretty interesting. So we can check out the, so what is this thing going to do? Let me see if there's any more momentum action going on. So on the daily candles, and this is kind of a couple month outlook, it's just tiny bearish momentum in bull territory, and it is making its way down a little bit. So I mean, I guess it could like just really slowly work its way down, but that's not usually what happens. Usually if it's making a weak bear move, it'll make a reversal in bull territory. Um, this is a pretty neutral move right here. It's just staying in bull territory, that's not reversing. It needs to get all the way down here. The divergence between the lines is not very big. There's not really bearish momentum. It's just kind of not really doing much, but it is still a bullish, a bullish kind of outlook on the monthly right here. But it's a little bit of bearish momentum in bull territory. So slightly bullish still there. And then, yeah, let's start swing through the, kind of work our way down from like a month to a week here and see where we are. So we're on the bear side. We're on the bear side and just kind of, yeah, okay, this recent little move just into like the next, I guess, kind of looking at the weekend. It's pretty neutral and mixed up. So like the longer term is sort of neutral and bullish territory. The medium term is kind of neutral and bear territory. And then as we come into today, we're just kind of neutral in bullish territory. Yeah, there's just not very much momentum right here. We're not really in a trend at all. And that's kind of obvious. We've just kind of been chopping sideways here. With a slight bearish angle, I suppose, but yeah, if this thing's gonna wave down kind of with this kind of lower target off this flat, it needs to do it right now. The more this thing waves out, then it's not gonna look like a bearish setup. This is already looking a lot less bearish there. Let me check out the dollar and see what's going on. The dollar has just kind of been wobbling in a slightly bullish. Yeah, it's still wobbling bullish. So it's kind of a weak bullish trend on the dollar. So that should, it should and does correlate with a kind of a weak bearish trend on the S&P. And I've been watching the Japanese yen because the yen keeps making moves that's predicting S&P drops. Like this drop here, this is dollar versus yen, but this drop here preceded the S&P drop we had a couple weeks. This drop here preceded the one that we just had, and not really getting a big drop here, but like if the yen drops out, that's kind of a cool thing that's been a decent indicator. And what else do we have pre-market? Where's the VIX? Yeah, the VIX is just kind of swinging around the trend line. It's not really doing much. It's high volatility, but it's not breaking out or doing anything special at the moment. Bitcoin, what's Bitcoin doing? Oh, Bitcoin broke down out of its little triangle that it had going. Okay. Yeah, Bitcoin might be breaking down now. It was being supported, and this is a pretty. Let me zoom out a little bit. This is a pretty long-term kind of up wedge it's been in, and it just broke down. So we'll see if it kind of breaks and backtests this thing and sets up a bearish-looking move or not. But yeah, Bitcoin has been not a leading indicator of the markets, but it's been selling off when the market sells off, which is kind of an interesting thing. And so Bitcoin may be trying to break down soon. And yeah, and that's pretty much where we are. We're kind of just in the middle of nowhere on the markets with very little momentum and high volatility. So big moves are possible. But yeah, just wild and nothing really to go off of at the moment. And really the only indicator that I have right now is the liquidity, and that's the big one. And from the fundamentals, as far as fundamentals go, the liquidity fundamentals are the ones that have actually been working recently. And so that's really what I've been looking at. And right now, as of the last 3 weeks, pretty much this whole period here has been a reversal of QE. QE stopped, it flattened out. It actually came down a bit, and now it's coming down even more. Not dramatically, but I mean, it's pretty much just flattened off. But that whole Fed pump that everyone keeps talking about is just straight not happening. For 3 weeks, it has not been happening. And so that's current. And right now, liquidity is down, and we won't get to see it again. That's all we have to trade off of for like the whole next week until until like next Thursday night it should post again. But this looks like another low liquidity week, and so the liquidity fundamentals are bearish. Those are bearish with high volatility, and so I think that's kind of the outlook is a bearish outlook with potentially big moves possible because of the volatility. But the setup right here is not it's not looking like a bearish wave setup right now coming into opening. So I don't really have any kind of technical trade setup on this for sort of a day trade or a swing trade. I just have kind of a week to week bearish liquidity kind of outlook right now. And so that's it. Let's look at the sectors. Where did these things close? Because financials, oh yeah, a little up move on financials yesterday. The financials and the small caps, this is the Russell 2000 IWM. Those are sectors that are not doing stock buybacks. Oh, there was actually news on financials yesterday that they're going to restrict their dividends and prevent buybacks on financials, which I don't know if that helps the stocks or not. I mean, the financial sector wasn't doing buybacks anyway, but that was weird. They came out and said that they're going to restrict dividends on the stocks. So, kind of, I guess that kind of gives the banks more money that they don't have to pay to people. I don't know if that's really good for the stocks. It's a weird thing. They're saying they're like stress testing the financial system and stuff right now. I haven't really figured out exactly what they're trying to do as far as the intermediate sized kind of banks go. But they are like futzing around with the rules with the banks again, and so they keep doing these changes, where they can increase liquidity and kind of affect the cash flows in the banks, and they're trying to keep the banks operating, and they're finding kind of where the jams are, like what's preventing the bank from making a loan or something. Like they want banks to be able to make loans, and banks are holding on to capital, they're holding on to their treasuries, and the Fed's trying to like make make loans happen, and they're not being as successful as they want to be, I don't think so. So yeah, that's kind of the thing. We're kind of seeing a derotation out of like the small caps and out of the financials, and these are the sectors that have, I think, the most sort of downside liquidity kind of fundamentals and solvency fundamentals, because the super low interest rates are really bad for financials. It makes it unprofitable for them to make loans and stuff like that. And like we've seen in Europe over the last 10 years, I mean, they had negative interest rates and it destroyed all of their banks. The banks were super unprofitable the whole time. And so American banks, are not negative, but the lower the interest rates trade, the worse it is for those. And then the solvency risk, as far as companies don't have cash flow to pay their debts, really, really hits the small cap sector, because those are the companies that aren't looking for bailouts. have a lot harder time getting loans and loan modifications and everything that all the tricks that the big companies can do. The small companies really can't do it, and they're not going to be backstopped by bailouts. Probably we'll see what happens. But as far as solvency risks, low cash flow, can't pay the loans, bankruptcy trouble, all of that. This group has the most risks as far as the U.S. group kind of goes, and the financials are just kind of weak, and they're looking weak now, which was weird. We had this big swing into financials and into small caps, and now we've seen it kind of swing back out. But the industrials are still up. I think yes, they closed up. So um, so the QQQs like the Infotech Industrial, these are the big companies that are still able to do buybacks. And so, the normal Fed liquidity has been able to get into this market via buybacks, not really to the amount that this chart would suggest, but they are still doing buybacks in this sector. But they're definitely not doing more buybacks here than they were over this whole bull market. Like they were doing way more buybacks. They've come down a lot, like I think like 60%. But these stocks are still able to do buybacks. So that is a flow into this kind of sector, like into the Qs, and not into these and these. So I guess as sort of a long, the Qs is still the best kind of long sector, and the small caps and the financials is kind of the weakest for, I guess, a short position. And that's what I have. I have just some shorts on here and a long volatility position. Just mostly cash, and this market is in a really weird spot that's hard to predict, but it's a little bit bearish. And these are kind of the bearish sectors, the small caps, financials. And yeah, I think that's pretty much all we can see for now. And so I'll come back and see if we're getting any hot stock news. We've had a lot of crazy kind of stocks coming out recently, which is fun. Like these SPAC companies that are coming into public trading by merging with like a public acquisition corp. That's kind of like the new trick to get onto the public exchanges before the company even has products or anything, really. So, normally companies need like actual product and a business model and a company, then a real business, to IPO and to go public. But now you just need like a pamphlet that like has an idea for a business, and you can just merge with one of these public acquisition companies, and then you're public. People can start trading your pamphlet on the open market, even when you don't even have any manufacturing or infrastructure or products or customers, nothing. You don't need anything anymore. You can just go right onto the public market with your pamphlet and sell your business to individual people. So so that's the kind of funny thing. I have like a bankruptcy watch list that has things like American Airlines, I think, is the worst balance sheet in that sector, and they're issuing bonds and stuff like that. But I started throwing those SPAC companies on that list, not thinking they're going to go bankrupt right now, but just kind of like um, just really these weird financial fundamentals that we're seeing right now. I have a list of those kind of companies to see if they start getting in trouble. So yeah, if you go check out my playlists, I have financial education playlists that talk about the general macro theories, and really, the most of the macro theories are they're not happening yet. So yeah, just trying to figure out when we're going to hit a point where one of those macro theories is spot on and you can actually run with it. But right now, none of the theories are really making sense or working that much, other than the the Davy day trader. The stocks always go up, like just nonsense kind of stuff. It is pretty nonsense right now, and yeah. So that's it for now, I guess. And Oh man, what are we gonna get today? It's just floating in the middle of nowhere with high volatility. And so we're just coming in with pretty dead momentum. So it doesn't look like it's anything exciting happening at the moment, but it could just blast. It could absolutely blast in either direction with the volatility that we have. So today I don't even have a prediction. The only setup that I had is already kind of dying, and I have to guess to the downside just because of the liquidity stuff, but the chart isn't suggesting downside at the moment like that. Yeah, that's pretty much neutralized the setup for kind of an expanded flat follow through already. So yeah, I guess like bearish liquidity, and I guess a slightly more bullish technical setup here. But we'll see what the action is when we actually get into cash trading or even the pre-market stuff. This is just the overnight look. So yeah, world GDP awful, really bad. Not twice as bad as they expected, but almost. And that is not a surprise to me. Like I've been saying that the whole world is in a worldwide depression. And America's in kind of a weird spot where it is sort of in the same boat, but America can print the dollars. So it gets really tricky. And US GDP, we didn't get an update on like this quarter. We got an update on last quarter that it didn't really change. And liquidity, Fed balance sheet is down, liquidity is down. So that's it. That's it. And not investment advice. Happy trading. Cheers.